Welcome, everybody, to another episode of Smart Money Circle. I'm your host, Adam Sarhan. Today, I have a very special guest, Mark Johnson, Managing Director at Optimum Investment Advisors, with over $500 million in assets under management. Mark, thank you very much for being here. If you'd like to begin, please just let us know a little bit about your story, your background, and how you got involved in markets.
Well, thanks, Adam. Good to talk to you. I've been in the financial career my whole life, the industry. And I think it's very interesting how the industry itself has evolved. Started out with Merrill Lynch as a retail stockbroker, went back to business school at University of Chicago. From there, I developed a career in investment research, ultimately leading to a position at a mutual fund where I helped manage a mutual fund, and then on to institutional hedge fund. So it's been a diverse career. It's been rewarding, and it's just absolutely riveting to be part of the financial world.
That's a great point about the evolution, too, of the financial world, which I'm sure we can touch on later. Mark, if you don't mind, please tell us a little about your investment strategy.
Yeah, our strategy is really to have a focused edge in the portfolio, to be basically on offense in achieving investment goals for our clients, Adam. One of the things that we run into frequently, and we can talk about it more in detail, is that there's been this vast movement to diversify in portfolios, which is a good concept, but frequently what we find is portfolios are way over diversified. People have no idea, what conditions or performance will perform well in, the portfolio will perform well in versus what it won't, how to adjust risk, et cetera. It's just very, very muddy. And so we try to cut through that and keep portfolios very clean. People that have investment portfolios that have an edge to them, so you know how they might perform in different environments. It's very important to us.
No, that's a great point. So we off air, we spoke about the diversification, which Peter Lynch talked about, and then diversification. I know you've managed money from all different shapes and sizes. What would you say is an example so our listeners can understand what you mean by being over diversified is a bad thing with that diversification?
Yeah.
Versus being properly diversified and the ultimate goal of investing, which you had mentioned to me earlier also, is making money. Can you please speak to that a little bit?
Yeah, sure, Adam. Give you a good example. A very sophisticated gentleman brought his account over to me. Was chief financial officer of a public company. The accounts that he brought over had 22 different exchange-traded funds, or ETFs. I would tell you that out of those 22 ETFs, they probably had anywhere between 1,000 and 1,500 different securities that they owned.
Wow.
Yeah. So mathematically, when you're talking about stock portfolios, if you own just 25 stocks, you have 95% of the benefit that you'll get out of diversifying. Your portfolio will look very close like the S&P 500 if you just pick 25 stocks randomly. So obviously, when you have 1,000 or 1,500, you own the market. You are the market. And I find that a lot, that people are way over diversified. And the implication is they really don't know how to adjust risk. It's kind of being done naively. Well, gee, if I just own everything, I'll be better off. And the reality is, if investors do that, they're going to end up paying higher fees than they need to, and they're going to end up with less than optimal results.
So yeah, that's a really good point too. Even though he has 15 or 20 or 25 ETFs, each ETF has hundreds of holdings. So he's got thousands of stocks, and he just owns the market. Yeah. So it's
the overlap too, Adam, was interesting. There's like active beta type ETFs. There's still the category specific, whether it's the UK portfolio, the EFA, any country specific. But a lot of times there's a lot of overlap between the securities. So Microsoft might be in 5 different ETFs and you don't even know it. And it's, so the weighting is just ridiculous. It's just very complicated. It doesn't make sense. And I worked with a trader one time in my career, Adam, on the institutional side. And he made the comment to me, he said, a lot of financial theory is really marketing. And I do feel like people have been marketed to this idea that he.
I love that, by the way. Sorry, I love that line.
Yeah. So somebody can tell you, gee, you ought to have 10% in China versus 6% in India, that's an easier call somehow than knowing that you ought to own Apple for the last decade.
Right.
You know, it's just ridiculous. And of course, there's a balance there. You want to be diversified, and that's what we try to do. We really try to identify what are the objectives for the account, what are core positions that we want to have in those accounts, and then understand certain risks that we want to mitigate. So for example, Adam, today, it's a troubled world out there. It's always has been some degree, but we've got $16 trillion of negative interest rates.
Right.
We've got valuations that are very high in some markets. So how do you build wealth? How do you sustain wealth, build wealth, generate income, and protect yourself from something untoward happening? And it's a full-time job these days, but we have specific strategies and specific positions that we have developed to mitigate the various risks.
So that's a really good point too. The troubled world that we live in. You had mentioned gold and commodities specifically. Would you like to speak a little about the midstream and the whole concept there to protecting?
Sure.
Okay.
Basically, for most accounts, what we do is we have 5 different buckets that we're really working with. Okay. Cash equivalence is important. Why is it important? Because it's a position of stability. Okay. Right. It doesn't go up or down. Sadly, today you get zero. If you've saved $1 million in retirement, you put it all into security of principal investments, you will qualify for financial aid because you'll generate about $10,000 a year of income.
Right.
So they're not paying savers. They're forcing people to take risk. The second bucket, but we want to have that stability of principal because it anchors the value of a portfolio, and it's a resource to draw on. If things get cheaper, you can move money out of cash, and you've got that to reallocate.
So it's safe to say, before you go to the second one, it's safe to say that you view cash as an actual position.
I do right now.
Right.
I do right now.
Okay.
There's a lot of, potential. The market may be peaking in the near term here. Is there a third kind of rally and failure a little bit? So I don't mind holding a little bit of excess cash to take a look at future opportunities with.
Right. The lesson is,
I think the returns.
Yeah, the lesson is you don't always have to be fully invested at all times. Cash is an actual position.
We don't try to market time per se.
Right.
But right now, the stability of principal feature of it is important.
Yeah, that's a very good point. Yeah, very good point.
Thank you. Second category is how to generate income for people. Ultimately, as people age, they need to have some income stream. Right. If you buy a 30-year Treasury bond today, it's 3% or less, and you're taking enormous risk. If you look at the 100-year charts on where interest rates have been, we are at all-time lows or negative interest rates around the globe, where you actually don't get your money back over a course of years. Austria issued a 100-year bond at, I believe it was 2% interest 9 months ago, and it doubled in value when interest rates went negative, and then it gave up 25% of the value when interest rates went back up just a little bit.
Right.
The point being, there's a huge amount of volatility, and people are chasing yield. They don't want to earn zero, and it's very risky on the bond fund area. If rates do turn around, in whatever condition we're in, you can bet 5 years from now it's going to look a lot different.
Right.
So you don't want to be chasing that, and we've got some specific income solutions that we work with, involved with writing covered calls on energy and mining issues. There's plays on that. There are natural gas pipeline positions. There are other REITs that are attractive that have growing cash flow streams. So it's very much a selective. We know we're taking risk with those positions. We're not trying to pretend it's going to be terrific. It's something you have to actively manage, but the returns are there if you do it correctly, in our view.
Understood.
The third bucket is, core equities. And while valuations are cheaper around the globe than they are in the U.S., the U.S. is still the leader in technology and new innovations. And there are disruptions in every industry. It's a tremendous time. I actually teach at a college locally, and I tell students, it's the best of times, worst of times. If you work for Sears the last year or two, it's been miserable, or the last 5 years. Yeah.
Right.
But if you worked at Amazon, it's been, wow, this is nirvana.
Right.
So that disruption is something to take advantage of, and we are not so worried about diversifying internationally. I think that's kind of a canard, if you will, because you can't buy a company like Apple internationally.
Right.
It doesn't matter where they're domiciled. They really sell all over the world. They're global. So the governance is better here. We are not, believers in, you need to have so much in China, so much here, so much there at this point in the cycle for sure. And we're skeptical of that long term as well. So core equities, try to identify areas that are actively disruptive with leading companies, that have attractive business models and valuations that are reasonable.
I like that. So that's capital appreciation would be that bucket.
Yeah, absolutely.
Understood.
And then another important component is to manage the overall risk. You do that through cash, but right now there's an enormous amount of money printing around the globe.
Right.
It's a huge number that's been added around the globe, and gold has always been a go-to place in times of duress. And gold has actually made new highs in terms of value in many, many currencies around the globe, not the U.S. dollar yet, though. The dollar has been relatively strong relative to other currencies, so the price of gold denominated in dollars is not at a record currently.
Oh, wow. That's a really good point.
Yep.
Yeah.
So it's an important dimension in a portfolio where the entire world is printing a lot of money, where interest rates, the cost of carry, as it's referred to,
right,
the alternative of giving up income is so low. It's like, why wouldn't you want to just hold gold instead of having it in the bank where you have a negative return? Maybe there are ways that we go about that. It's not that simple, but that's the general idea.
So with specifically one of our prior conversations, you had mentioned there's a few ways of doing it. One would be owning the physical gold. One would be owning the ETFs.
Right.
The individual mining companies would be a third way. And then the fourth way would be the streamers. Just to help educate the audience a little bit. Can you talk a little about that?
Yeah, sure, Adam. Again, this is not a huge part of the portfolio, but it's an important part of the portfolio.
Understood.
So if you own physical gold, picture going out and buying a piece of gold or some gold coins, you got to store them. You got to put them in your safe at the house. You got to put them at a safety deposit box or whatever. There's a cost of storage there. In a worst case, meltdown, maybe that's the best way to go, but we're a long way from that right now.
Right.
Okay.
Right.
So the second means is to maybe buy an ETF, an exchange traded fund, GLD. There are other tickers that quote invest in the price of gold movement, but there's a lot of noise in there too. There's more shares of the ETF out there than underlying gold positions. It's not a very attractive way. Plus, the tax treatment is not attractive. You end up with a collectible tax by owning GLD that is less attractive than other means.
Right.
The third way to go about it is to buy an individual mining company. Kirkland Lake has been a great mining stock. Maybe that's the way to go, but you're limited to whatever deposits they have in their particular mines, and maybe geographically they're in places that you're not as comfortable having a great big position in.
Right.
So, and there's also a lot of operating risk. They don't perform as you hope. There's not as much gold as they thought, or silver, or whatever the mineral. So we kind of favor the other approach. There are some publicly traded streaming companies, which basically go out and raise capital and become a specialty bank
Okay.
to mining companies.
Oh, nice.
And they structure their compensation by buying gold from the people they finance at low rates. So if gold goes up, their profitability goes up quite a bit. Names there that are been around a long time doing a good job. We find those to be very attractive ways to participate in metal, have a very diversified portfolio, have managers that are picking specific investments in production as opposed to buying the whole mine. And it's worked out real well for our clients.
Oh, that's fantastic. So just to summarize here, to make sure we have these 4 big points with respect to the risks associated, or the hidden risks associated with diversifying a portfolio. One is you want to make sure that your portfolio, you're managing it to handle the overall volatility. In other words, are you managing portfolio volatility well, or
Right.
you own the market, like what you had mentioned earlier? The second big point is, how do I manage the need to generate income in a low return world based on what's happening now? The third one would be, how can I manage growing the value of the account without taking on too much risk? So that's capital appreciation without taking on too much risk. And then the fourth bucket would be, how can I protect myself in the event of a large sell-off or economic or the next financial crisis or what have you? Is that correct?
Correct. That's absolutely correct. And then developing, we work with our clients. We iterate with them on approaches to risk management and investment objectives. So it's specific to each client. We might use the same vehicles, but the mix between different asset classes and overall volatility risk is different for different clients, depending on their age, their wealth situation, et cetera.
Understood. So, Mark, earlier you mentioned about the evolution in the financial business or the space. Can you speak a little about that?
Yeah, it's really interesting, Adam. I mean, back in the 70s, commissions were fixed on Wall Street. If you wanted to buy a stock or a bond, you had to go to a brokerage firm to be able to execute it. Today, you can execute on a computer anywhere in the country.
Right.
And it's the evolution of tradings. It used to be, I think, it was around $100 to execute a trade for 100 shares at a brokerage firm in the early 80s.
Okay.
Now you've heard recently Schwab and E-Trade have cut their rates to zero.
Right.
For trading. So you put it all together, and what once was a service to execute trades is now turned into wealth management. There are a lot of wealth managers of different pedigrees, different orientations. You've got large corporations that do it, that are there to try to scale $1 trillion of assets and have all their clients look alike, and just that orientation, and that's really led to a lot of mutual funds, a lot of ETFs is a means to get a bunch of exposure for clients and run the portfolios. $1 trillion, for instance, if you're a large bank, is not unusual in their trust department. And you end up with portfolios that hold many asset classes really don't have much of an edge to their performance. Okay.
Right.
So and then you've got at the other end of the spectrum, you have smaller financial planner types that have a different approach to investments, a different skill set. And so we're kind of in the in-between spot there, where we're very much active managers. We pay very close attention to the investments we hold. We're very specific in what we invest in. We develop portfolios that are very customized for each investor based on their own risk.
Understood. So to help me understand, Mark, the evolution here. So back in the day, or just help the audience give them some color, traders or people couldn't trade unless they called a broker, they called an advisor, and then that professional would execute the trades on their behalf. Today, you can literally trade from a cell phone if you're up in the airplane on Wi-Fi, and you can place trades or anywhere in between, right? So it doesn't matter. and now commissions are zero. So that evolution, people don't actually have to pay for that service of execution. They're going to more pay for the advice and or the intellect or the intellectual component of, hey, as an overall holistic wealth manager approach, what's best for me in my situation. And as people grow and change, their situation changes, whether it's their needs, their objectives, whatever the case may be. Is that correct?
That's correct, Adam. And you bring out a really good point too, where which is really important to say too. Active management versus passive has been a key issue. Where passive managers, these are the ETFs. Nobody looks at the balance sheet. Nobody cares about the income statement. Just buy me exposure to Europe or exposure to small caps or exposure to value companies or whatever.
Right.
Whatever metric. There's nobody taking a look at the actual balance sheet or income statements of the companies there. They're just buying a broad swath. That has grown to be a larger segment of the market today than active management.
Right.
And we feel very definitely, the intellectual support for that came from the fact that active managers were not producing excess returns over a period of time versus indexes. Well, that's very true, but the real issue there is managing risk is important too. And, the industry has again evolved to this hodgepodge of a bunch of ETFs out there, nobody really reviewing, positions. And as a result, we feel very definitely active management has a role to play in mitigating risk and developing portfolios that will perform over time.
So yeah, just to clarify to the audience, the concept of passive management is you just buy a basket of ETFs, which, by the way, part of that evolution you spoke about, these didn't exist years ago, right? ETFs is a relatively new thing. 20, 30, 40,
Right.
50 years ago, ETFs didn't exist. So, or maybe 30, 40, 50 years ago. So the passive investing is just buying something that's correlated to the S&P 500 or the mid caps or whatever the case may be, some other benchmark, and holding it. Doesn't matter if the market goes up, down, or sideways. You're just holding it because you're passively investing for the quote unquote long term. Could be 30, 40, 50 years. And in an uptrend or an upward market, that does very well. But in a downtrend or in a bear market, you get annihilated. The active component would be the managing the risk and picking the stocks and or picking a basket of whatever the case is to protect against the massive bear markets that do happen from time to time.
Absolutely agree, Adam. I mean, that's the evolution of the industry that I was talking about. We've all heard the advertisements like, why own one restaurant stock when you can own them all?
Right.
Now, I would throw that back to you from a consumer standpoint and say, why don't you eat at all restaurants?
Exactly.
Some of them are too expensive. They don't taste good, right?
Right. Are they? Yeah, exactly. So why would you want all of them in your portfolio?
Yeah, exactly.
So this
is the kind of evolution of the industry. There will be a shakeout with this too.
Yeah.
You've seen it all along. And I think at the end of the day, investors need to be ready for that. You need to have a diversified portfolio. You need to address the risks that are present, the risk of generating income without being too exposed if rates go up, the risk of being able to participate in the growth of the economy and in fabulous growth industries without suffering huge drawdowns in the next bear market. The risk of protecting your portfolio if there's a financial crisis, that if there is, when the next one comes along.
Right, not if, but when.
Yeah.
Right.
So those are the kind of things that we're really focused on. We think we have an educated approach that makes sense.
So onto a broader topic, Mark. If you can go back and tell your 21-year-old self something or give some advice to your younger self, what would it be and why?
I think at that age, the thing is to take risk, to learn, to go ahead and explore, take risk. You've got lots of time. And I think that to trust your intuition too. I mean, I love teaching college students today, just because they've got blank slates when they come out of college from a financial perspective.
Right.
They can choose literally, and it's really about being intentional. Being intentional in what you do, having an intention in being true. You might say, well, gee, I want to look like a bodybuilder, but if you really don't have the intentionality to control your diet and to get into the gym, you're not going to get there.
It's not going to happen, right?
Yeah. So it's a disciplined approach, and having the vision, the intention, and taking the risk and listening to yourself too. In the financial world, all educations cost money.
Right.
All education costs money, and you'll learn from every move you make. And we try to work with very informed clients that really outsource a lot of the decision making to us. But at the same time, we participate with them in developing the portfolios as well.
No, I love it. That makes perfect sense. So, Mark, I mean, you've been around and you've managed money, institutional money, and managed money for decades here. And
Yeah.
what would you say would be one or two or a few just common mistakes you see people make when dealing with their money and or managing the money, and then how to avoid them?
Yeah. The biggest one are the Dalbar studies, which would show, and this was kind of an issue too that developed where we took away defined benefit plans and replaced them with defined contributions 401ks, but people don't have the foggiest idea on what to do. They chase performance. The technology stocks have outperformed a lot for 3 years. I guess I have to buy more of that. That kind of thought without understanding. So that's a very key thing right up the bat right there, that not to chase performance,
So,
to have a perspective.
sorry, so just to clarify, so chasing performance, in other words, the stock had a big run or this manager had a big run and the stock's now up 30, 50, 100%, whatever it is. I just want to go in
Right.
and buy it just because of the sake that it's up with no
Right.
concept of anything else and not thinking about what might happen after it goes up. It could go back down and have a normal 20% retracement, wipe you out in the process, and then go back up and
Yeah,
double or triple again. So that's the concept of don't chase the performance. Is that what you're saying?
that's correct. And Adam, I just taught yesterday in a college setting, and I just was walking through the students on how value is created.
Oh, that's
Why do we invest in the stock market? Why do stocks perform over time? What drives them? And a lot of times people don't understand that, and they get involved for various reasons that they don't really have the fundamental understanding of what they're trying to accomplish. And it's a dangerous place to be if you don't know what you're doing at particular points in the market.
so I think Warren Buffett had the quote of people pay price is what you pay for and value is what you get, right?
Yep,
So
absolutely right.
when you invest in a company, I mean, how do you, I know value largely is subjective, but are there any
Yeah.
ways of how you look at value differently than, or help the audience learn about analyzing value properly?
Yeah, absolutely. I mean, the whole magic that's involved is companies accessing capital. They get money,
Okay.
and they address needs in new products. They invest in people, technology, advertising, facilities, equipment, et cetera. They make those investments.
Right.
So they get capital either from their existing earnings, retained earnings, or new capital. And it comes in, they make those investments. And if they're good at allocating those dollars into those areas, people, equipment, facilities, advertising, et cetera, they will generate a return that's higher than what the capital cost them to get. And that will create value.
Oh, that's a
Okay.
great, yeah, that's a great point. So what you do with the money.
Exactly.
Right.
And that's really the magic of it with capital costs so low today, because we have negative interest rates around the world. We have all this stuff. There are opportunities for companies to exploit that and become very, very profitable. Okay.
Mm-hmm.
So I think that's the key message there, is that, understanding how value is created. The other thing that I would tell investors, know why you own something. Value is very difficult to ascertain sometimes. If you would have looked at GE, for instance,
Right.
the stock was the cat's meow in the 1980s.
Right.
It was and you might look at it and go, well, gee, it was $35. It's at 20 now. That looks pretty interesting. The PE, the price to book, the whatever. But in reality, stock went down to single digits. And it's still debatable as to really, what their businesses are worth. So you need to be careful with that and understand why you own something. If you own something because it's a value, you need to have markers out there to keep you protected.
All right.
Because you're going to be wrong in the investment business. You're going to be wrong. There's no doubt about that. Periodically, you're going to be wrong, but you need to manage being wrong and understand, what are some of the indicators that it's not working out. Your head up, you're going to do fine.
Oh, fantastic. Well, Mark, thank you very much for being here. How can people get a hold of you or get in touch with you? What's the best way?
We are in Chicago at 33 North LaSalle, Suite 3700. We also have offices around the country in a few locations. The best number is 312-456-3338.
Okay, and your website, if you don't mind giving that as well.
Yeah, it's www.optimum, OPTIMUM, investmentsingular.com.
Well, thank you very much, Mark, for joining us, and we'll talk to you hopefully soon.
Thanks, Adam.
Thank you. Bye-bye.
Bye.